Stocks, also called shares or equities, represent partial ownership in a company. When you buy a stock, you're purchasing a small piece of that business and become a shareholder. As a shareholder, you may receive dividends, which are a portion of company profits, and have voting rights at shareholder meetings. The value of your shares can increase through capital appreciation if the company performs well, allowing you to sell them for a profit. However, if the company performs poorly, your shares may lose value. To summarize, stocks represent partial ownership in a company. As a shareholder, you may receive dividends and have voting rights. Your investment can grow through capital appreciation when the company performs well, but you may also experience losses if the company struggles. Let's explore how to start investing in stocks. The path to becoming an investor involves several important steps. First, you'll need to open a brokerage account with an online broker. Popular options include Fidelity, Charles Schwab, and Robinhood, each offering different features that may suit your needs. The account setup process typically involves identity verification, linking your bank account, and transferring funds. Be sure to compare fees, available investment tools, and educational resources before choosing your broker. Before investing, it's crucial to define your financial goals and understand your risk tolerance. Your financial goals might include saving for retirement, a house down payment, or building an emergency fund. Your risk tolerance depends on your time horizon, financial situation, and comfort level with market fluctuations. Once you've set your goals, start with a small amount you can afford to lose. Begin with regular investments, even if they're small. Many brokers now offer commission-free trading and no minimum investments. For beginners, index funds and ETFs are excellent choices because they provide instant diversification across many companies. Modern investment platforms offer features that make it easier than ever to start investing, even with limited capital. These include commission-free trading, fractional shares that let you buy portions of expensive stocks, and mobile platforms for investing on the go. Remember that investing is a long-term journey. Start small, stay consistent with your investments, and continue to educate yourself about the market. When trading stocks, you can use different order types to control how your trades are executed. Market orders buy or sell immediately at the current best available price, regardless of the exact price level. With a market order, your trade executes immediately at whatever the current price is, which could be different from what you see quoted if prices are moving quickly. Limit orders allow you to set a maximum price you're willing to pay when buying, or a minimum price you'll accept when selling. The limit order will only execute when the price reaches your specified level or better. It may not execute at all if the price never reaches your limit. Stop orders, also known as stop-loss orders, become market orders when a stock reaches a specified price, helping limit potential losses. When the price hits your stop level, it triggers a market order, which executes immediately at the best available price, which may be different from your stop price. Stop-limit orders combine features of stop and limit orders, giving you more control over your execution price. With a stop-limit order, once the stop price is triggered, it creates a limit order at your specified limit price. It will only execute within your price parameters. Each order type serves a specific purpose in your investment strategy. Understanding when to use each type will help you execute trades more effectively and manage risk. Understanding these order types helps you execute your investment strategy more effectively and manage risk in different market conditions. Bull and bear markets represent the fundamental cycles of stock market behavior. A bull market is characterized by rising stock prices, typically during periods of economic growth. Investor sentiment is optimistic, and these upward trends often last for extended periods. This chart represents a typical bull market trajectory, with prices generally trending upward despite small corrections. In contrast, bear markets represent periods of declining stock prices and pessimism. The formal definition of a bear market is a decline of 20% or more from recent highs. These periods often coincide with economic contractions and are typically characterized by investor pessimism. Bear markets generally last for shorter periods than bull markets. Here we can see the typical downward trajectory of a bear market. Over time, markets cycle between bullish and bearish periods. Bull markets, shown in green, represent periods of growth and expansion. Bear markets, shown in red, represent periods of decline and contraction. Understanding these market cycles helps investors adjust their strategies accordingly. During bull markets, investors typically focus on growth and might increase their equity allocation. During bear markets, a more defensive approach is often warranted, with higher allocations to cash or bonds. Historical data provides valuable context for understanding market cycles. On average, bull markets last about 97 months with a total return of around 440%. Bear markets are typically shorter, lasting about 18 months with an average decline of 40%. While predicting market transitions is extremely difficult, long-term investors can benefit from both market cycles. The most important takeaway is that throughout history, markets have always recovered from downturns, though the timing is unpredictable. Investors use two main approaches to analyze stocks: fundamental analysis and technical analysis. Fundamental analysis evaluates a company's financial health by examining several key factors. These include financial statements, which reveal revenue growth, profit margins, debt levels, and cash flow. Management quality, assessing the leadership team's track record and strategic vision. Competitive advantages, such as brand strength, patents, or cost advantages that help the company maintain market share. And industry trends, to understand the broader market conditions affecting the company. The ultimate goal of fundamental analysis is to determine if a stock is undervalued or overvalued compared to its intrinsic worth. In contrast, technical analysis studies price movements and trading volumes using charts and statistical indicators. Technical analysts look for patterns like support and resistance levels, moving averages, and momentum indicators. These patterns help identify potential entry and exit points based on the assumption that price patterns tend to repeat. Many successful investors use a combination of both approaches. Fundamental analysis helps identify quality companies with strong long-term prospects, while technical analysis helps with timing market entries and exits and understanding current market sentiment. This balanced approach helps investors make more informed decisions, combining company fundamentals with market timing. Both methods provide valuable but different perspectives on investment opportunities. Let's examine the common investment mistakes that many new investors make. The first common mistake is investing without a clear plan. Many investors buy and sell randomly based on emotions or tips. In contrast, having a clear investment plan with regular contributions leads to more consistent growth and better long-term results. The solution is to create a well-defined investment strategy based on your financial goals, time horizon, and risk tolerance. The second mistake is attempting to time the market. Many investors try to predict market highs and lows. Market timers often buy high when markets feel safe and sell low when panic sets in, leading to poor results. In contrast, successful long-term investors make regular investments regardless of market conditions, which averages out the purchase price over time. The solution is to adopt a long-term perspective and use dollar-cost averaging to invest consistently over time, rather than trying to predict market movements. The third mistake is letting emotions drive investment decisions. The market moves in cycles, and our emotions often lead us to buy high and sell low. Emotional investors often buy when they feel fear at market bottoms and sell when they feel euphoria at market tops. Successful investors make decisions based on research and stick to their strategy regardless of market emotions. The solution is to create a disciplined investment process based on research and analysis, not emotional reactions to market movements. The fourth mistake is neglecting diversification. Many investors concentrate too much of their portfolio in a single stock or sector. A concentrated portfolio exposes you to significant risk if that investment performs poorly. In contrast, a diversified portfolio spreads risk across different asset classes. The solution is to spread your investments across different asset classes, sectors, and geographic regions to reduce overall portfolio risk. The fifth mistake is trading too frequently. Excessive trading often leads to higher costs and lower returns. Studies show that frequent traders typically earn significantly lower returns than those who buy and hold quality investments for the long term. Frequent traders face high transaction costs, tax inefficiencies, and often make timing errors that hurt their returns. In contrast, long-term investors benefit from lower costs, tax efficiency, and the power of compound growth over time. The solution is to adopt a buy and hold strategy focused on quality investments that can grow over time, rather than trying to make quick profits through frequent trading. The sixth mistake is focusing solely on stock price without understanding the underlying business. Many investors focus exclusively on price movements and market sentiment, chasing stocks simply because they're going up. Successful investors focus on understanding the business fundamentals, competitive advantages, management quality, and financial health of the companies they invest in. The solution is to focus on the quality of the underlying business rather than short-term price movements, because over time, stock prices tend to follow business performance. To summarize, successful investors avoid these common mistakes by developing a disciplined approach, making decisions based on research rather than emotions, maintaining a long-term perspective, and focusing on the quality of their investments.